Okay students, our topic today, lesson today is on supply of money. First we need to define what we mean by money. Money can be measured in broad terms and in narrow terms. Okay. When we define money in narrow terms, this is what it means. Narrow definition of money includes only items that can be spent directly, such as cash and current account deposits in banks. Since they can be spent directly, how do you spend them? Using checks, using debit cards. This is sometimes referred to as the monetary base also. Okay? And narrow measures focus on items which are used primarily as a means of exchange. When we do broad definitions of money, we will realize that broad definitions include the narrow definition when money is used as a medium of exchange, plus when it is used as a store of value. So, broad definitions of money additionally include various items such as deposits and savings accounts in banks that cannot be spent directly. These are your time deposits, okay? But which can nevertheless be readily converted into cash. Broad measures include items which are used not only as a means of exchange but also as a store of value. These are the definitions of what money comprises. Okay, now let's talk about, before we study the supply of money, we need to understand a little bit about what a central bank is and what commercial banks are. Some of the functions of central bank will be explained over here too. Now what does the central bank do? It has basically, all countries with their own currency will have a central bank. There are two vital roles or important roles that the central bank performs in any economy. Number one, to oversee the whole monetary system and to ensure that banks and other financial institutions operate as stably and as efficiently as possible. Second, to act as the government's agent, both as its banker and in carrying out the monetary policy. So we know central bank is often called the banker's bank. It is also called the government's bank because it performs the functions of a bank for the commercial banks and the government. We will see what all that entails. Okay, now let's see what are the functions. These are some of the functions we can look at. Now, it issues notes, we all know that. It acts as a bank to the government and to the commercial banks. This means the government's account sits with the central bank. And commercial banks also have their accounts with the central bank. It keeps the foreign exchange reserve deposits, we know that. It manages the government's borrowing program. It oversees the activities of banks and other financial institutions. Remember students, the monetary discipline has to be imposed or has to be there. So the central bank works with the various financial instruments, the methods that it has in order to regulate the activities of the financial institutions. Okay, then you have that it operates the government's monetary and exchange rate policy. It acts as a lender of the last resort. For example, there is a run on the bank needs money, then right away the central bank will step in and provide that money in order to prevent a run on the bank. Okay, we are looking at sources of money supply, and to understand that we will look into circumstances, into what's happening when there is, or what happens when there is what causes an increase in money supply. What are the causes of it? First one, when commercial banks lend more, there's an increase in their lending. We will do this in detail. Just the points now. Secondly, the government budget, when it is budget deficit, when it is financed by borrowing from the banking sector, as in banking from the commercial bank or the central bank. Then there is a net inflow of funds from abroad. We will go into that as well. Let's start with the first one. Okay. Okay. The first is an increase in commercial bank lending through credit creation. Students, what do banks do? Banks take deposits from depositors and they pay them a certain rate of interest, right? Now, how do they pay this interest and how do they also make their profits? What they do is they pay the depositor a lesser rate of interest and they charge anyone who is borrowing from them a higher rate of interest. The difference that they get is with which they will pay their costs and will make a profit. So what banks do is when you deposit money with them, they will want to lend it to someone. So they will create loans or what we call advances in order to earn interest from there. Okay? So they create credit. For every deposit that is placed, a new initial deposit that comes in, they are able to give out loans and create. So let's just read this slide and then we will do it numerically. What is credit creation? Let's understand. When commercial banks give loans or advances on the basis of new deposits, each loan creates a new deposit which leads to another loan. We will see how that happens. How much can the deposits increase in this way will depend upon the reserve ratio required by the central bank. So students, if I deposit $100 and the bank gives out that $100 to somebody else as a loan or advance, then when I come to the bank and ask them for this money, they will not have it. They will not be able to pay me. So the banks can't do that. The banks can't lend out the whole amount that has been deposited. So a fraction of that deposit has to be kept with the central bank who oversees this to make sure that the bank has sufficient liquidity to pay its depositors when they come in to cash their checks or when they want to spend that money, right? So what the central bank does is, the central bank determines a certain liquidity ratio, or what we call a minimum cash requirement that commercial banks must keep with them. Now this minimum reserve requirement is also called the operational balances of this bank, which are sitting with the central bank, alright? Now it's for the central bank to decide how much they feel is the reserve or the ratio which must be there with the bank, okay? So we will work with certain percentages. We will first start with 1% as the liquidity ratio required, then we will go to a higher percentage of liquidity required, then a lower, and see what happens to commercial banks called high street banks or retail banks. They make most of their profits by lending to customers, and when they lend, they create money. This is because when a bank gives a loan, which is also called advance in the textbooks, the borrower's account is credited with the amount which he has borrowed. From experience, banks have found that only a small proportion of deposits are cashed. This means they are not expecting everyone to arrive at the same day and ask for all their money back. That will not happen. So they know that they will have extra cash with them. What do they do with this? They lend it out. However, they have to be able to meet their customers' demand for cash. The central bank requires them to keep a fraction of these deposits as operational balances with the central bank. And this is the minimum reserve requirement, or reserve ratio, or liquidity ratio. You can give it any one of these names. The ratio of an institution's liquid assets to total assets is known as its liquidity ratio. This is the, we'll just do the liquidity ratio in a numerical form so you can understand. The reserve ratio or the liquidity ratio continue. Reserve ratio determines the value of the bank deposits multiplier, also called the money multiplier or the credit multiplier. So we take out first the formula. 1 upon liquidity ratio will give us our multiplier. That's the number of times one initial deposit is going to multiply and be created into money, so the money supply will increase. We will just do a numerical. Okay. First, let's find out the value of the multiplier, see how a new initial deposit of $100 will lead to an increase in money supply, and then we will do the other calculations. Okay. So let's assume that the central bank of this country wants the commercial banks to keep at least 10% of any money which is deposited with them, so that they can meet the requirement of the depositor when he comes to cash his check. So the value of the bank's deposits multiplier will be, given our formula was 1 upon the liquidity ratio. That's 1 upon 10%, which is the same as 1 upon 0.1. So this is the value is 10. So for any new initial deposit of $100, we will multiply it with this credit multiplier or money multiplier. This means overall by how much will more deposits be created, or more deposits will be created to the extent of 1,000. And this 1,000 will include the initial $100. Let's see how this works. We will do a numerical this time. Now, the important thing for you to understand is that when you get your MCQs, the examiner can ask you how much is the change in deposits or liabilities, or conversely he can ask you how much is the change in advances and loans. You have to be careful when you look at the MCQ because they both mean two different things. This includes the initial deposit that was put in. On the basis of this initial deposit, more deposits and loans were created, right? So when we do advances or loans, the initial deposit is not considered to be the advance or the loan, okay? So we have to subtract that. So whatever value we get over here as the increase in deposits, from that we subtract the initial deposit which started this whole chain, and so it's going to be 1,000 minus the initial deposit of $100. So essentially students, loans or advances will increase by $900 and deposits and liabilities will increase by $1,000 because they include the initial deposit. We will now go on and do this as a numerical example. Students, let's do a numerical example assuming that the central bank requires the commercial bank to keep a 10% liquidity ratio. That's the minimum requirement. Let's start with somebody who comes in and deposits $100. Now this is a new deposit that has been created. We are also assuming that there are two banks in the whole banking system. Of course there are many banks, but what is happening with two banks can happen with, as we can apply it to a number of banks. So let's say in bank one somebody comes and deposits this $100. Now what will this bank do with it? It will first have to make sure that it keeps $10 in its reserve, which is the requirement of the central bank. And the remaining $90 it can give a loan to someone. So Mr. A comes and asks for a loan and bank one gives Mr. A a loan of $90. So a loan is created of $90. Now let's say Mr. A now makes a payment to Mr. B. Okay, so what does he do? He pays him, maybe in the form of check, he pays him the check. Mr. B has his account in bank 2, so he goes and he deposits this money in bank 2 as his $90. Now when this $90 is received by bank 2 as a deposit, bank 2 again has to keep 10% of this with the reserve. So because that's the minimum reserve is a requirement of the central bank, so out of this $99 will go as reserve. And the remaining $81, this bank can now loan out to somebody else. So let's say Mr. C comes and asks for a loan and this bank can give this person $81 in the form of loan. So Mr. C takes this loan and then he goes and makes a payment, he buys something, right? So he buys it from Mr. D. So he gives Mr. D this check of $81. And Mr. D goes and let us say that Mr. D's bank is bank number 1. So whichever bank it might be, he goes and deposits it in the bank. So let's say he deposits it in bank 1. So a deposit is received by bank 1 of $81. On this $81, again 10% has to go to the reserve, and the remainder can again be created as a loan or given as a loan to somebody who comes to bank 1 for a loan. Essentially what has happened? The new deposit came in, it created one loan, this loan created a deposit. This deposit again created a loan. This loan again created a deposit, which again created a loan. So we see this is how money supply will expand, okay, or will increase, so to say. So students, if we look at the total, if we keep on doing these calculations, we will come to a conclusion where we will find that the total amount of deposits that will be created, and we did that in the slide, will be this $100 multiplied by the money multiplier. It is also called credit multiplier, okay? And we said that the value of the money multiplier is given as 1 upon the liquidity ratio. Alright? So it's 1 upon 0.1, our value came out to be 10. That is the size of the money multiplier. So 100 multiplied by 10, our answer comes out to be $1,000. So this means you add up this 100, you add up this 90, you add up the 81, so on and so forth. When you add up all of that, it will come out to be 1,000. And what about the loans that were created? In the loans, what happened was this first deposit was not a loan, it was a deposit, right? So loans will be 1,000 minus this initial deposit of 100. This means loans of $900 will be created. This is how you will calculate your changes in money supply, for example. Alright. Now, given that, we can practice out, or you can practice out, changing the reserve ratio to 20% and changing the reserve ratio to 5%. We can have a look at that as well. Or you can practice it at home. Let's just calculate the size of the money multiplier with that and then just do a numerical over here. Alright, the process will remain the same, except that if it's at 20%, then 100 may say $20 will go out in the form of reserve and only $80 can be created as loan. And when $80 are created as loan over here, then 20% of that which is $16, will go over here as reserve. So what will happen is the amount of the size of the loan that is created will become, and deposit that is created will become smaller and smaller. So money supply will increase, but not by as much as it would increase if the reserve requirement was lower. So if reserve requirement is lower, money supply will start increasing. If reserve requirement is higher, then money supply will start going down. So if the reserve requirement or reserve ratio required is 20%, what will happen? Money supply will fall. Okay, banks will start calling in their credits. They cannot expand their credit so much. And what is going to happen if the reserve ratio is 5%, because we started from 10%, money supply will go up. So let's see what our money multiplier will be. If this is the case, our money multiplier will be 1 upon 0.2, 0.2 being our reserve ratio, liquidity ratio. So this will give us a value of 5. So that means every, for example, a new deposit of $100 will lead to increase in deposits of 5 multiplied by $100, which is $500. Previously it led to an increase of 1,000. Now, because the reserve ratio was 10%. And how much of loans and advances would be created now? It's going to be 500 minus initial 100 deposit. So loans and advances can go up or be created to the tune of $400. Right? So what did we find? Banks cannot create as much credit. They will, if the higher requirement is required by the central bank for the reserve, they will have to reduce the loans which they are giving to people. Okay? They will have to call back some of their loans in order to be able to meet the requirement. Alright. Students, that covers our value of reserve requirement and how it is going to affect the money supply. We did this by working out manually different values to see how credit is created. Okay. Then we also talked about changes in the minimum ratio, the 20% and 5%. Let's just quickly read this. The central bank can influence the ability of commercial banks to lend by changing the minimum reserve requirement. If the central bank increases this minimum reserve requirement, what will happen? Money supply will fall. If the central bank reduces this minimum reserve requirement, banks will be able to create more credit, they will be able to lend more, money supply will increase. Okay, we worked with numbers over there. This is a numerical example. I'm just skipping it because we've already done this. Just project it for a second for you. We've already done this. Now, if it is, if the money multiplier, if you use a 5%, then the amount by which your money multiplier will be 20. If 5% is the liquidity ratio, right? So 20 will be your money multiplier, and a deposit of $100 will create 2,000 new deposits, which includes the initial deposit, okay? And then when you subtract the initial deposit from it, this is going to be the amount of change or increase in loans and advances. Okay, now students, just because the central bank has changed the liquidity ratio, increased or decreased the minimum, let us say it has decreased the minimum reserve requirement. So will money supply increase to the hilt? This means if they have taken it down to 5%, the reserve ratio. So is it true that the banks will create so much credit? The answer is no. What the money multiplier tells us is the potential that the banks have to create credit. Whether actually that much credit is created or not depends on a number of things. So this means there are limitations to how much this money multiplier might actually operate or have the effect on the economy of the full amount. So the first one, which is that we made an assumption. We said that when a deposit was made, Mr. A comes and asks for a loan, and then he pays to Mr. B, and then a Mr. C comes and asks for the loan. Students, if there is no demand for loans, this means that people don't want to borrow from the bank and spend, whether it is people, whether it is firms, that means they are not borrowing. Then in that case, the bank is not able to create credit, and the bank is left with a lot of liquidity. Okay, so the first let us say limitation to the operation of this multiplier, credit multiplier or money multiplier is, the process of credit creation assumes that all loans made, this one, okay, this one, this is the second point which I have explained first. Commercial banks may not lend out as much as the money multiplier implies. This could be due to a lack of borrowing by households and firms, or because of certain uncertain expectations people don't want to borrow. So this was the first point I have explained. Now let me look at the second point. Okay, the second point is essentially that when the bank gave me, for example, I went, somebody had deposited $100 and I went and I asked for a loan of $90. I got the $90 loan, but I did not spend, or let us say I did not pay Mr. B this in the form of check. This means उस $90 में से मैंने कुछ dollars in cash form अपने पास रखे. So they never got deposited back in the other bank. All right. So it says here, process of credit creation assumes that all loans made are returned to the banking system as deposits. There may be leakages from the banking system whereby all loans are not returned as deposits. This will dilute the impact of the money multiplier. Last point, the central bank has allowed you to create credit up to a certain point. They have said you are required to keep at least 10% liquidity ratio. That's your minimum reserve requirement. But the bank does not want to lend to the hilt. So what the bank is doing is, although it can create credit up to a certain amount, it is not doing that. It is holding back because they want to protect themselves maybe against some kind of liquidity crisis. So they are keeping themselves more liquid than what is the minimum requirement. Okay. So these are the three reasons why the credit creation may not go to its maximum. So this is something you're going to put in your discuss answer, because discuss requires that you look at the other side as well, which means what are the limitations to the creation of credit by the commercial banks. So far we have done one point of how money supply can increase. We have understood that money supply increases when the commercial banks start lending or creating credit. Alright? And how much they can lend is controlled by the reserve requirement which the central bank gives. But everyone should be clear about how banks lend and create money, so to say. Alright. Let's go to the next one. The other thing which the central bank can do, apart from the reserve ratio, is what we call open market operations, also called OMO. Now what does the central bank do? The central bank buys and sells government securities, government bonds in the open market. So what happens is, the central bank, when the central bank sells the bond, so the bond goes to the public, to the people, okay, and people pay the money to the central bank. So they are drawing on their deposits in the commercial banks, right? So what is going to happen? The commercial banks' balances will go down. This will contract money supply. Money supply will fall. So when the central bank is selling the government securities, money supply will fall. Conversely, if the central bank is buying the securities, this means there's some people sitting over here, I am the central bank representative, and they are selling me the bond. So what will I do? I will take the bond, the central bank takes the bond and gives them money. So when the central bank gives them money in the form of a check drawn against the central bank, automatically this person will go and deposit this check in his or her account with a certain bank, Habib Bank or any bank. So what will happen? Automatically Habib Bank's operational balances with the central bank will go up. So then Habib Bank will start creating credit, for example, right? So that's the concept of how through open market operations the central bank can impact or affect the capacity of commercial banks to lend. Alright? I'll just read this through very quickly. Besides using the reserve requirement as a tool, the central bank may also seek to influence the commercial bank's ability to lend through open market operations. These involve the central bank buying or selling government securities to change bank lending. If the central bank wants to reduce bank loans, wants money supply to go down, what will it do? It will sell the government securities. So the security passes to the people and they pay in the form of giving central bank the check. And the central bank collects this check in a way the operational balances of the commercial bank go down and their ability to create credit goes down. Okay, the purchasers will pay by drawing on their deposits in commercial banks, and so cause the commercial bank's liquid assets, which are the operational balances sitting with the commercial bank, to fall, and that will reduce the ability of commercial banks to create credit. Conversely, the central bank purchases these or buys these government securities from the people, then it increases the ability of the commercial banks to lend, like I explained. Alright, so these are two ways in which the ability of the commercial banks to create credit will go up or down, leading to an increase or decrease in money supply.